Look at this 1912 Brazil Railway Company share certificate. For over a century, if you wanted to own a piece of a business, you had to securely store a physical document exactly like this one to prove your wealth. Today, wealth moves at the speed of light. You execute a trade on your phone, and a fraction of a second later, the ownership of those shares is transferred entirely as digital code. To handle millions of these instant transactions securely, the modern Indian stock market replaced paper certificates with a mandatory dual account system. This comparison matrix breaks down the two halves of that system. On the left is your Demat account. Think of this as your digital vault. Operated by a central depository, it charges an annual maintenance fee to securely lock away your long-term assets. On the right is your trading account. This is the active bridge managed by your stockbroker, charging commission fees to execute your live orders on the exchange. They are designed to work together. You place a buy order on the trading bridge, and once the transaction clears the market, the actual shares are deposited into your Demat vault for safekeeping. Now, when you sign up with a modern broker, they usually bundle both of these accounts together into one neat package. But you are not actually restricted to using just one setup. Regulatory laws explicitly allow you to open multiple Demat accounts at the same time, provided you open them through different brokers. This creates a very practical dilemma. Should you juggle multiple accounts to hack your commission fees and separate your risk, or is that just stepping into a massive administrative trap? The right choice comes down entirely to the mathematics of your personal volume, whether you are passively building long-term wealth or actively trading every single day. Before you can map out a multi-account strategy, you have to understand how money actually moves through the system. Those digital trades are routed and processed through major physical hubs, like the National Stock Exchange here in Mumbai. Because of the massive daily volume at these exchanges, India enforces a universal speed limit on how fast assets can move between your trading bridge and your vault. It's called the T+1 settlement cycle. This timeline breaks down exactly how that works in practice, starting right here on T-Day. This is the exact moment you hit buy or sell on your broker's app. If you are buying, your purchased shares do not actually belong to you immediately. They officially hit your Demat vault on T+1, the next working day. But if you are selling, updated regulations give you a major instant advantage. You can use 100% of your sale proceeds to execute new trades on the exact same day. The purchasing power is yours immediately. However, if you want to formally withdraw those cash proceeds entirely out of the broker's platform and into your physical checking account, you still have to wait for the back-end system to clear on T+1. And keep in mind, that cycle strictly counts working days. If you execute a trade on Friday afternoon or right before a market holiday, your assets are locked in transit until the market reopens. You have to factor in this mandatory back-end delay. When you start splitting your capital across multiple brokers and platforms, a one-day delay on withdrawing cash can severely complicate your strategy. So why intentionally split your capital? The biggest strategic edge to having multiple accounts is pricing. You might keep one account with a full-service broker to access their high-end market research, while executing your actual trades on a separate discount broker to pay fractionally lower commissions. But this strategy triggers intense regulatory oversight. The Securities and Exchange Board of India, headquartered right here, makes it mandatory to link your single PAN card to every account you open, ensuring your total wealth remains visible and authenticated across all platforms. Take a look at this scorecard to see the immediate financial drawback. Every single Demat account you open carries an annual maintenance charge. Adding a second or third vault stacks these recurring baseline costs against your portfolio, even if you don't actively trade on them. Then there is the administrative toll. You now have to manually compile fragmented tax liabilities, audit long-term capital gains, and balance portfolios across distinct, disconnected platforms. If the hassle causes you to ignore one of those vaults for too long, the central depository will flag it for inactivity and freeze the account solid, locking your assets inside until you submit new KYC paperwork. To justify these headaches, seasoned investors use multiple accounts purely for defense. They place their safe long-term retirement stocks in one vault and do their highly volatile short-term trades on an entirely separate platform. In fact, if your specific strategy is pure intraday or futures and options, you bypass the storage problem entirely. Those trades are purely contractual and don't deliver physical shares, meaning you only rely on your trading bridge, not the Demat vault. Running multiple platforms offers incredible strategic flexibility, but it absolutely guarantees higher fixed costs and a heavy layer of management stress. The final decision on your setup shouldn't be based on what the regulations allow, but rather what mathematically matches your trading volume. We can map this out on a simple decision tree. The first question to answer is, are you a casual long-term investor? If your primary goal is buying steady mutual funds or accumulating blue-chip stocks, your optimal route is simple. Stick to a single bundled Demat and trading account. By avoiding multiplied maintenance fees and cutting out hours of tax management, you keep your overhead at zero and protect your return on investment. But if you bypass that, you hit the second node. Do you actively trade futures, options, or high-volume intraday? If you execute dozens of trades a week, the math changes. Here, opening a second account with a specialized discount broker makes sense, as the money saved on high-volume commission fees easily offsets the extra maintenance charge. More importantly, it forces psychological discipline. You build a literal physical firewall between your safe retirement wealth and the highly volatile capital you put at risk every day. Just don't let aggressive broker marketing or temporary sign-up bonuses trick you into opening accounts you don't actually need. Every Demat vault you open is a legally binding financial entity connected to your tax profile. Protect your capital, manage your overhead, and only add complexity to your life when it serves a calculated purpose.